This meeting is being recorded.
Okay, well, welcome everyone. Thank you so much for joining us today. We have an excellent group of panelists joining me, and I'm excited for our discussion. If it is your first thoughtbot event, a little bit about us. thoughtbot is a product agency. So we work with companies, clients of all sizes, stages, and industries to figure out what's the best product they should be building and then helping them design and develop that product. So we work with a lot of startups in the UK, and we've been chatting with them about their fundraising efforts. How's it going? Sometimes good, sometimes bad. And we thought a good way to equip our clients and our community with some great information would be to facilitate this discussion with folks who have been there. So we have assembled this group of panelists, some founders and some investors that have insight into these experiences and will be sharing their journeys in hopes to help others. So joining us today, Arish Shah, the founder of Emerge One. Arish is the founder who is on a mission to provide CFO support to early stage ventures. He's helped teams grow 3 times year over year and is proud to have worked with some of the UK's best startups in their scaling journey. Chloe Sweden, the founder of Plants and Perks. Plants and Perks allows organizations to reward employees with sustainable perks. They are on a mission to empower 1 million employees to live healthy, more sustainable lives. Thank you, Chloe. Rosie Phillips is an investor on the consumer team at Octopus Ventures. Octopus Ventures invests from seed to Series B. She's on the lookout for world-changing tech companies in the consumer space and is particularly interested in shifting behavioral trends in consumer psychology. And since 2008, Octopus Ventures has helped back over 160 teams and is one of the largest and most active venture investors in Europe. So we're thrilled to have you, Rosie. And last but not least, Kyle Grant, the founder and CEO of Oxwash. He is an entrepreneur, innovator, and ex-NASA scientist who has a focus on sustainability, engineering, and data-driven modeling. He founded Oxwash, which focuses on decarbonizing the unsustainable and toxic laundry and washing industry. They have brought to market a brand new model for a hyperlocal, carbon-neutral, tech-enabled washing service. So some all-stars here, absolutely, and we're so excited to have you today. The agenda for our session is the first part. We'll go through some facilitated discussions. We've got some questions prepared. And then at about the halfway mark, we'll open it up for Q&A. So as attendees, if there's definitely something you want to ask any of our panelists or just get the input from the group, please have those questions ready, and we look forward to digging into those. So we can go ahead and get started. I thought a nice way to kind of set the stage of where everybody is at is to share what stage are you in regards to fundraising. And Chloe, it sounds like today is a big day for you.
It is, yes. I'm literally pressing send on my my investor teaser decks. So yeah, for our seed round. So we raised pre-seed and we closed that in March this year. We raised about £375,000 and we are just about raising our next million. And yeah, and that starts today.
That's amazing. Congratulations.
Thank you.
Kyle, what is the status of Oxwash currently? What are you thinking about?
Yeah, so we closed our Series A fundraise earlier this year in August, which we started raising probably in March, April of the year. So it was an interesting journey, just as the market went off a cliff to try and ride that groundswell into closure was an interesting process. We've done a seed round and a pre-seed round before that as well. We raised 300k, then we raised 2.7 million, and we've just raised 10. So that's the kind of cadence in raising that we've done.
Nice, congratulations. And Arish, for Emerge One, how are things been going?
So I guess to segregate out the businesses I'm involved in, so Emerge One, obviously we see a lot of our clients going through funding rounds, and there's definitely been some blood in the water at the moment. Definitely very, very difficult for a lot of them to raise. Equally, others are still sort of moving forward and are able to secure funding. Equally, I have a second business projected, which I'm sort of currently raising a pre-seed for at the moment. We raised a sort of friends and family last year, which was super easy, and then went out to market in June 2022, which is probably the worst time in the last 15 years have gone out try and raise funding. So we've got some interesting conversations happening, but yeah, it's by no means done and dusted.
Interesting. So a lot of different sort of milestones across the group. So it'll be interesting to hear your perspective on some of these prompts. Thank you for sharing. This is a good one for the same for all of you. What do you feel plays the biggest role in being able to successfully fundraise? And is it different from when you were able to do that previously? Do you think it's different now?
I can jump in with kind of my thoughts there. You know, I have a podcast, I interview a lot of VCs and investors, and typically they say, you know, the most important thing is kind of team. And I would definitely say that is one of the core critical components in terms of fundraising. But at the moment, traction is becoming even more important, right? So if you're raising, and of course there are different pools of capital from which you might raise. So you can raise from angels, you can raise from VCs, obviously there's debt funding and so on. If you're talking about the venture market now has moved quite a long way back towards fundamentals, where not only are VCs looking for growth, and that means sort of, you know, 2x year on year, 3x year on year, but also looking for strong, stable unit economics, so that you are, you know, you're acquiring customers for less than they're providing you in terms of value. So I think at the moment the biggest you know, the thing that plays the biggest role in startups successfully fundraising, I think is manifold, and I would argue it is team, it is traction, and it is having, you know, a product that has the ability to scale rapidly.
Yeah, I think that's a really good point, and I'm happy to kind of add to that as well from a VC point of view. I think, as you said, Arish, unit economics now is something that VCs are focusing on more than ever because of the current climate is changing so much. But I think also in terms of actual teams going out and starting the fundraising process, two of the things that I've seen that I think can help teams be successful is more to do with the timing and the preparation. So one of the key questions when VCs look at startups who are looking to fundraise is kind of why now? Why is now the right time for your business to fundraise at whatever stage you're at? And looking kind of towards, depending whether you're doing a seed or a pre-seed or a Series A, is have you hit the right kind of growth metrics? So the traction, the month-on-month growth and things like that Arish was saying, that would be expected for a company of that stage. But also, has the company in general kind of got to a point that you think it's at an inflection point, and it's about to kind of go on a massive growth curve, and why is now the point that you should be fundraising? I think fundamentally, when you can raise money from investors is when you can convincingly sell your story to an investor that now's the right time, and you're convinced of that yourself. And on the preparedness thing, I think fundraising can be really difficult, and I'm sure everyone else on this panel will have more experience with that than I have. But having as many conversations as you can before you actually start the process, talking to other founders to kind of understand what the steps are like, making sure you've got all the right materials ready, whether that's your deck, but also things like your data room, and just talking to as many people as you can and really getting as much feedback from people on your deck and on your sell and on your investor case before you actually start that process. I think those are kind of some of the differentiators that we see that really stand those teams apart, who are really well prepared and have thought through kind of why now is the right time, and they've done the steps to help get them to that point that they're ready to fundraise.
Very interesting. Thank you, Rosie. Chloe or Kyle, do you have anything you'd like to share? What, now reflecting on the success you were able to achieve and the milestones ahead of you, what do you think helped you be successful?
I can jump in with something maybe more near term, which is when we were going through our Series A fundraising, our conversations with VCs really started to focus around capital utilization. So, you know, they're looking at the businesses that they invest in and saying, okay, for every pound that we invest, like how much inflection will we cause? You know, the idea might be brilliant, but the way the organization is run, the product market fit, all of that composes that capital utilization and efficiency of scale. And in a downturn, you bifurcate business behaviors into two buckets. One is you go hell for leather to gain market share when everybody else is asleep, so that when you come out the other side of a downturn, you've been able to gain a lot of ground and a lot of traction. Or unfortunately, the opposite bucket is you basically go into stasis, right, to try to ride out the wave. And VCs that I've spoken to and a lot of friends are looking for that first, and the former bucket to invest into companies that look like that for every pound that they invest will get more than the sum that they invest back in terms of market share gain at this period, which I think is really fascinating. And it takes a lot more diligence in the market, the model, the product market fit, the competitor base, and the landscape that they operate in to be able to make those decisions with conviction. But almost certainly when they are made, the bet is a good one. So I think my advice to anyone listening raising is try to preempt that question by saying, look, this is how we're going to use your capital efficiently. Like, this is where it's going to go. We've made the plan. We know money in will come with growth and will come out the other side with traction. Whereas a lot of companies I see fundraise with capital utilization as an afterthought. They're just excited to get the capital in the bank in the first stage. I think it shows real professionalism to show how you're going to use the capital effectively.
Could I just add one quick sort of thought there as well? And I think I'd fully agree with Kyle. The other thing, I think, you know, we haven't talked about it, as I say, there are different pools of capital that you can raise from. One really important question that you have to answer for yourselves, especially if you're going out after venture capital, is, are you the sort of business that VC will invest in? And that isn't about whether you have a good idea, whether you're a strong team. It's whether or not your business can grow to an extent over a relatively short period of time, which can lead to an exit that allows a VC to return their fund, because that is the mathematics and the calculus that they're effectively doing. If they've got $100 million fund, then every single investment bet that they take, because they're all betting on power laws or following the power law rule, every single investment they make, they're making a bet that that investment will raise the fund. So if you just do a really stripped down bit of venture maths, it's a $100 million fund, and they invest, let's say, a $10 million check for 10% of your business, or even $1 million check for 10% of your business. They need you to grow to $1 billion in order to, and that's assuming no further dilution, in order to return the 100 million of the fund. So you've got to really, you've got to really think about what is the outcome that you can expect to make. And a big problem I see with a lot of startups is, yeah, they've got a great business, but it isn't a venture backable business necessarily. And equally, VC takes you down a path that can be quite difficult for a lot of businesses. So I think, the answer to what plays the biggest role in startup success in fundraising is, should you even be fundraising in the first place?
Right. And the due diligence to make that decision, right, and have thought through those different answers, to Kyle's point.
I can put a bit of a different perspective on it potentially, because I would say optimism and resilience at the moment. As a female founder, looking at the stats that have just come out, that 3% goes to female founders at a time when our costs are spiraling just like everybody else's, when my founders within my space are going bust left, right and center. It's really tough. It's really tough to get up every day and have to look my my employees in the eye and be like, we're going to make this, we're going to do it. And fundraising is a marathon. It really is. You can't go in there, and I'm like, joking, going, today's the day, but I'm not like, I'm not being let out of the gates like a greyhound. I'm very much kind of like setting out with my crampons and massive bag on my back and ready for the long haul. So and I think my experience might be quite different from others. It might be quite similar to some of the people who are here today. I literally had to Google how to get investment when we were doing our pre-seed. A lot of my contemporaries at university went on to public public sector. I didn't go to a private school where I've got a huge cohort of people that went into finance. I don't have a network. And so actually I was surprised that nobody talked about a network as playing one of the biggest roles of successfully fundraising. That's something that I've had to build over time, and you have to build the right network. It actually doesn't help you if you build up a network of VCs that would never fund pre-seed businesses. So it is incredibly difficult, but I would say that actually if you have optimism and resilience, you can sort of go through and overcome quite a lot of the obstacles that hurtle your way as a founder.
That's very helpful. And understanding that, it's not going to be a one and done sort of task. It's going to be research and trying and pushing each step of the way. Very helpful, Chloe. Thank you.
And I think I'd completely agree, Chloe. And one thing I'd add to that is just start speaking to investors as early as you can, because the earlier you can start building those relationships with the kind of investors that you want to lead your next round, it helps on both sides, because then you're not starting from ground zero the day that you send that deck out for the first time, but also then those VCs that you've been chatting to for weeks or months have more of an understanding of you as a person, as a founder, and your company. And if they've seen you kind of execute over the period before you start fundraising, and kind of got to know you better, I think that helps so much, both on the successfully fundraising side, but also I think making it less of a daunting process for founders as well.
Sure, I like that. And it's a good way for them to get a sense of your team and your approach to growing your product, growing your business.
There is one, and this is slightly flippant, but it is very true. Like, the other thing is, if you have already been a founder or have come out of a successful founding team, your chances of being successful, even on a pre-revenue, pre-idea kind of business, or pre-revenue, pre-product business rather, it is substantially higher than if you haven't. So yeah, obviously that is the other sort of unspoken kind of rule. Like, if they know you from that perspective, you've got a much bigger chance of getting funded.
Yeah, great point. I'll take us to our next question. Currently, what industry or market trends do we feel are most impacting startups' ability to fundraise? And based on those trends, does anyone here have any tips for navigating those successfully? That's a tough question.
I'll dive right in. Cost of living crisis is killing consumer investing. When your available paycheck to spend on new product, services, and things that aren't your bills, which are going the roof, becomes very, very difficult. And if you look at the amount of investment going into D2C brands, businesses, new businesses, is very low. What we're seeing is that venture capital are really focused on the portfolio they already have, helping them to really thrive, survive during the downturn, rather than taking more punts, which is really interesting. But then conversely to that, you do see the hedge, which is investing in underlying technologies that will probably take some time to develop for the other side of the downturn, which is the obvious recovery of the economy when spending from consumers proportionally goes up. So building those technologies that underpin certain things like subscriptions, feedback loops, data analytics, like all of these kind of things. Yeah. If you're looking for a company that's going to return the fund in 5 to 7 years' time, now is the time to invest in those underlying technologies, because they do typically take longer to develop, and therefore the timing at the other side of the recession is perfect for that exit potential. That's something that I've seen across a couple of different consumer funds for sure.
Yeah, I think the picks and shovels approach is like across many industries makes sense. Sorry, Rosie, I cut you off. Why don't you dive in? I'll come back.
No, you go for it. I'll go after you.
Cool. So I'd 100% agree with Carl in terms of the consumer tech. I think there's also a broader problem at play within the consumer the consumer sort of vertical, in that back in the day, it was easy to arbitrage on your acquisition costs. It's very hard to do that now. Everyone is fighting for the same dollar. Like, it is no longer, for argument's sake, people fighting over one pair of sneakers versus another. you're fighting, sneakers against glasses, against, DIY services versus barbecue equipment, et cetera, et cetera. So I think that there's definitely a big problem there. I think obviously cost of capital. So that's the other big elephant in the room at the moment. So as interest rates rise, if you think about, again, how VC works, VCs are effectively spending money, or they're investing the money of their LPs, of the people that invest in their fund, right? So those LPs do their investments based on some sort of a portfolio style of thinking. And part of that will be, where can I get the best returns? Now, when interest rates were near as damn it zero, like obviously you're going to take more risk because you've got more opportunity for return. As interest rates have been climbing, that calculus again changes, and you start thinking, well, okay, do I deploy less into venture capital and more into, let's say, bonds or other more traditional assets? And I think, again, allied with that is, as the downturn hit over the last sort of 6 to 12 months, effectively what's happened is people's positions have been marked down. So like the value of their assets have shrunk. And what that means is, if you've got, let's say, 10% of your portfolio was allocated to venture capital, let's say as an LP, and you had 50% in equities, well, those equities are now rebalanced down to maybe 30% of your portfolio because they've been marked down so substantially. And now you're overweighted in venture capital. So potentially some LPs are starting to shrink back from putting their cash back into funds. So that isn't something that is necessarily very openly sort of out there, and there's not necessarily masses of statistics around that, but I think that's definitely one of the problems that we're also likely to see, which is LPs holding back and investing in fresh funds. So and to follow on a little bit from what Carl said, it's not just consumer funds. I think across the VC landscape, I'm hearing that funds are deploying less into new deals and are definitely keeping a lot of their dry powder dry for follow-on rounds into existing portfolio companies, so that so that they can see them through.
And I'd just add to that as well. I think it's definitely a different game today than it was kind of in 2021. But from my point of view, at least, I mean, there's still a lot of money for investors and VCs to deploy. And it really depends on the fund and how funds are structured as to whether their risk appetite has changed in terms of how much money they actually want to deploy and whether it's really affected by the market and other things going on. I think the main thing from our point of view that seems to have changed as well is kind of more of the rules of the game. So valuations today are drastically different than they were last year. And I think in 2021, it was a bit of a crazy world. I think there was a point that fintech valuations got to 25x multiple revenues, which is nuts. And I think 2021 was actually a bit of a wild year and was the highest that valuations have ever been in the tech world anyway. So companies today, I think we're seeing a lot of companies raising down rounds, so raising money at lower valuations than their last rounds were. Revenue multiples are much lower than they were before. And I think VCs are still deploying money and still investing, but there's just a bit more kind of diligence going on the back end. Things are less hot maybe than they were in 2021, when you'd see VCs like Tiger Global giving someone a term sheet the day after they've spoken to them for the first time, and those weird things that only happened last year. But I think, yeah, there's still money out there. Investors are still looking for good companies. And I think, just to build on what Carl and Arish said, we're also seeing a lot more of kind of bridge rounds. So rather than people raising, if they're planning on raising, say, a Series A now, they're raising smaller bridge seed rounds to basically tie them over and extend cash runway for the next 18, 24 months, to wait until the kind of market stabilizes a bit and they can raise at a better valuation than they would be able to today. So I think in terms of tips, our advice would basically be, and it's a bit of a vicious circle, I think it's a lot of hype and people think there's no money and valuations are really bad, so no one comes out to market, so good companies don't raise, and it's a bit of a vicious circle. But I think our advice is kind of just be prudent with the cash that you're using and extend your runway where you can. Focus on, as Arish was saying before, things like your core product, your unit economics, the scalability of the product, making sure that in a consumer recession like this, that you can basically survive it. yeah, basically think of if you need to raise now, what does that look like, and long term, is it better to do it now or wait a little bit?
Right. So that timing still plays an important role in the ask, and also how you have those conversations. That makes a lot of sense.
Just to add to that, we're doing exactly that, Rosie. So we're raising less. So we're raising $1 million, which was sort of less than we potentially would have done if the economic situation would be different. I would sort of sum up everything that everyone said as kind of fear. There's more sort of fear in the market, I'd say. And I guess as a startup, what you can do to mitigate against fear is to be fearless and to be confident in your product, and to make sure that when you go out there, you're talking about all the things that kind of mitigate against risk. So why are you a much less risky proposition than someone else? And we want to avoid a down round. We don't want to have that to happen in the future, which is why we're raising less now. We're also looking at convertible notes, ASAs, you know, kind of equivalent of YC safes. You know, just so that we don't have to have the conversation about valuation now. So that's also something that that I think startups can look at, ASAs, ways in which you can sort of avoid the conversation on valuation now to avoid the conversation on down rounds in the future.
That's great. Very helpful.
Could I completely agree with Chloe. Like there is a lot of value in raising, because you can do a rolling close in ASA, right? So you don't need to get all of the money in one shot. You just raise as you go, right? So you can take in 10,000 check, 25,000 check, 50,000 check. If you can find those checks, like, let's be clear, it's not simple to go out there and just hustle for those sort of checks. But there was a question that just came up about whether at very early stage, it's the same sort of thought process. Definitely high net worths are I would say, they're still deploying, but they are, again, being more thoughtful, and they also understand that ultimately, whatever they put money into today, they want to see a return on in the future. And if they're down round, like if the markups that they're getting or the exit opportunities via, VC secondaries or later rounds, they've got to make, they've got to assume that every business that they're putting money into has to be able to raise at a higher valuation in the future and get to some form of exit for them. So they're definitely being slightly more cautious. They've also had retrenchment of their own personal portfolios. I'm sure there's been a bunch of margin calls made on a lot of these guys over the last 3, 4, 5 months. And I think, a lot of them are definitely feeling the pinch from that perspective. The positives, and we were talking about this earlier, obviously, the recent mini budget stroke next budget stroke whichever budget's coming next announcements around SEIS and EIS in terms of the sunset clause being extended and the SEIS limits being raised is massively positive at very early stage, because that is taking away a lot of the risk from those investments to those investors at those earlier stages, and you should absolutely try and capitalize on that if you can.
Very helpful. And yeah, maybe we should jump into the question we just received. So I'll summarize it for the group and see if anyone else wants to chime in. What is the panel's view on early stage investments in the funding winter? Are they expected to remain strong or will be similarly impacted due to HNWI portfolio restructuring? So curious if anyone else has an answer there on what they're thinking.
I could add some color to Arish's point as well from a slightly different perspective, because I completely agree the UK market for early stage fundraising, because of these tax incentives where early stage companies basically get free bets from investors, especially angels. The SEIS scheme is incredible, right? You literally put your money into a potential startup that if it folds, you get your money back. It is a free bet off your tax bill. And that is unique, and it's amazing. It's wonderful to see it, being extended. However, what I've certainly seen personally is that a lot of people are being more conscious with where they're putting their value, their EIS and SEIS allocation. And if your company doesn't have an explicit impact and it's not purpose driven, you give yourself a real heavy weight on your back to carry through to explain. And you can see that in all metrics, that businesses and startups that are combating inequality, climate change, any number of SDG objectives, typically right now are able to raise much more per unit of investment time, because people are looking to use that capital and those free bets and the SEIS and EIS structure in something that makes them feel good and less guilty about themselves, as well as the capital upside as well. And I think it's just conscious consumerism, but falling over into the investor side as well. So I think as an industry, if you're in that impact space, you're going to typically fare better, because quite frankly, a lot of people also realize that if we don't invest in these technologies and companies now, we are all fucked in the next 50 years. It's black and white. And I think investors, we hope, are pretty smart people and understand it's a pretty good bet to invest in those things combating that apocalypse. So that would be something that I think is hopefully slightly more immune to the downturn we see right now.
Sure, that makes a lot of sense.
I certainly hope so too, Carl, being within the sustainability space, and we definitely saw that, I think, with our first raise. And actually, just to build on what you said, we got a lot of our investment from US angels. So the other thing I would say is, the US is slightly more gung-ho. Appreciate there's been a downturn everywhere, but there is, of course, there's the EIS, the SEIS in the UK, but actually in America, they have pretty good tax breaks as well on early investment. But they're just a little bit more gung-ho, and especially within the impact community. They are looking for innovative new ideas that they're not seeing, and they weren't seeing anything like us in the US, which was fantastic for us. And a lot of our investors came from the US. It became quite interesting to navigate because when you don't know both the legal jurisdictions in both territories, but it was definitely worth doing because we've opened up our opportunity to the US as well, which, given kind of like future traction for global enterprises, gives us a global base. So I would also say look outside of the UK.
I would just add to that, right now, definitely look at the US because of interest rates and exchange rates. So at the moment, the UK is on sale. So effectively, not only have our valuations been compressed, but in US dollar terms, they're damn sight cheaper because they're now able to, buy, sterling's buying $1.13 versus $1.25 in the past, right? So in terms of US investors coming to UK, we're a hell of a lot less expensive right now. So one thing to definitely do is raise in US dollars and have your expenses in sterling. That's the other thing I would definitely suggest right now.
Thumbs up from Kyle. Thank you for sharing. Okay, moving us along. This is a good one. What helps startups stand out from others, from other competitors or others just fundraising in a similar space?
Happy to add a couple here. I think one of the main things for me, and I'm a massive sucker for storytelling, and I think whether through your deck or through your pitch or when you're just talking about your company, I think being able to tell a really good, powerful story of why you are building, why is it you that's building this company, and why are you the right person to build this company, why you're passionate about the space, what led you to the point where you are today, where you're building this company, and kind of how your previous experience and things kind of combine into that as well. I think telling an effective story of where you are now, how you've got there and where you're going, for me is one of the most effective ways that people can really stand themselves apart from other startups. And then I also think, other than that, I think being engaging and creative, whether that's in the deck, as VCs see hundreds of decks every month, and anything you can do to try and make yourself stand out. Sometimes it's just maybe putting a video in your deck or other things which might just kind of add that extra little bit of zhuzh that makes someone want to find out a bit more. And also I think just whatever you can in terms of including like strong metrics or growth, whatever you've got that you think really drives the story of why you are doing really well right now, make it as hard as you can for that VC to say no, basically, and make them want to know more.
Great insights. Thank you.
I think adding to that, like put those metrics right up front in the deck, right? Don't bury them. So 15 slides in. Like, so, in my current round, I think on average, like I've been sending it out via DocSend, our decks had like a minute, right? Per person that's looked at it. That means that they're not spending a huge amount of time on any individual slide. It's got to capture attention. It's got to grab them by the heart. And exactly as Rosie said, it's about the narrative. Like, the reality is that so investors are not investing on, a financial story alone. They're actually investing in the narrative about you and the business and why it's going to win. And I think not only keeping that story really concise, but also keeping it visually attractive is massively important, which is why, like we always tell people, maximum 10 to 15 slides in a deck, one line per slide, or a couple of bullets max per slide. If you have a product, show the product. Like so many founders don't show their product when they're pitching investors, right? Again, build the relationship with those investors day one. I've been really fortunate. I've built relationships with investors for the last 5 years before I even looked to raise investment, right? Now, I've been turned down by a huge bunch of VCs, but they've all taken my call, right? So it's about showing that you have, you know, the desire to succeed, and you have the ability to communicate that desire concisely, which I often have a problem with, certainly when I'm speaking. But it's being able to tell that story in a super simple way that they can understand. Because remember also, most VCs aren't domain experts in the thing that you are building, right? Most VCs are generalists to some extent, and they may have an understanding, but they may also have seen, I don't know, whatever, you know, the numbers are typically 3,000 decks, 300 calls, 10 investments, or something along those lines, right? Like that is your chance of getting in, getting VC funding, is basically you are in a pool of 3,000 that leads to 10 investments at the bottom. So you've got to be able to tell a VC or an investor of any nature why you can be differentiated from all the other people that are solving the problem. And believe you me, there is always someone solving the same problem as you, albeit in a slightly different way, right?
I can jump in as well. I would just say be better. Just be better at everything. Be the best presenter, be the best boss, be the best CEO, be the best salesperson, you know, just across the board, just try and be better at everything, because ultimately, if you're nailing everything, then you're going to stand out. I know that sounds a bit glib, but I think, you know the numbers of startups that fail, you know those numbers, you know what you're up against. And so it's not even just a question of whether you're going to be, you know, how you can stand out in conversations with investors. How are you going to stand out to your competitors in the marketplace? How are you going to stand out to your clients? Like, you just have to be phenomenal across the board. Sorry, and have a spaniel that's by your side always.
I can add maybe some theatre as well to this question, because, you know, fundraising is an exercise in creating FOMO, right? And that's what makes you stand out as much as possible, because as you've all said, and I completely agree, it's a funnel, right? And VCs are being blasted for attention from all different domains, organic, through the inbox of the website of the fund itself, through tenuous introductions from portfolio founders that are like, oh, some person threw me a deck, what do you reckon? Through a WhatsApp group. By far the best approach to stand out is a warm introduction from somebody that a VC respects already and is maybe invested in and has, you know, worked together for some time, or they've co-invested on multiple different deals previously that are performing well. So I typically try to map out those investor relations ahead of time and work out, okay, these are the funds we'd like to speak to because they have domain experience. But yeah, I completely agree, Arish. How far does that go is as long as a piece of string. But you can then see in your network who knows who and go to those people to allow you that warm introduction where your deck goes to the top of that massive pile, because it's come from that channel rather than it's just in amongst everything else. And you have to hack the system. It's not fair. You've just got to play dirty and play clever to get your deck in front of the eyeballs of the person that makes the decision. There's also another frivolous side to this, which is you've got to be speaking to the right people in the fund as well. Too many times I've seen, and I've made this mistake loads of times, and Rosie, forgive me for being brutal, but you could start speaking for days and hours with an analyst or an associate that has no stake on the IC, and then you still have to do the same job another couple of layers up. If you can get introduced directly to at least an entity within the fund that's part of the DMU, the IC, so that you go straight in and your time's efficiently spent convincing the person that actually has a say on the deal or not, that's definitely the best way to stand out from just this enormous upwelling of stuff that gets brought from the ground up. Well-run funds, that's less the case because associates actually have a voice. But unfortunately, and I think Rosie will probably agree, that's maybe the majority, and the minority is not so good.
Yeah, and I think, I mean, I do agree, Kyle, but I would say it's something that's changing slowly but surely. And I think I'm probably biased because I'm at Octopus, and I think we've had a very big kind of focus recently of trying to take out the bias from our internal processes. So trying to do things like, trying to understand firstly, why do we typically pay more attention to decks that come from our own network? And that is unfair, and that leads to bias in the system, and things like female founders or underrepresented founders getting less funding. And those are things that fundamentally we want to change. So, I mean, every fund is different, and I can only speak for Octopus, but we've put in quite set, rigorous processes in terms of the process you have to go through from an initial introduction to getting to the IC, to the point that it doesn't matter who the first person is that you speak to. If it's an analyst or a partner, it will still be a first introduction call and then meeting the wider team. And there are those set processes that are trying to counteract, I think, as you're saying, Carl, what has been the norm in this industry for a really long time. But I know that's not the case everywhere, but I hope that it is something that's changing.
Yeah, well said.
That's very cool. I think we've got time for one more, and then we'll open it up for Q&A. This is a good one. So how do you identify the right investors and begin a conversation? We talked a lot about the importance of a network, but I'm curious your answers on the first part of this question. How do you identify who's the right investor for you?
Work. It's exactly what Chloe said. You just got to be the best, right? Which just means you got to go research every single person you're talking to. My CRM for investors on this round is currently at about 250. All of those 250 are vetted. Like I've vetted to check that they are investing in my space, will invest at my round size, or potentially are conversations that I want to keep in the loop for the future. You know, but I equally have, like, I had a list of, I think it was 900 connections on LinkedIn that have investor in their title. I've slimmed that down, and that's above and beyond the 270 that I've or 250 I've already approached. And I narrowed that list down from 900 to 300, and I went through each and every one of them individually and checked, like, are they investing? Do they look like someone that is actually investing regularly, has the capital to be able to invest, has the intention to invest in this sort of a space? If they're a consumer investor, don't send them a fintech startup. Like, that isn't going to work, right? So how do you identify the right investors and begin the conversation? So the first part of that question is, do the work. Look on their website, look on their LinkedIn, look at what they're doing, look at the deals that they've already done. If you're able to speak to other founders that they've invested in, that might be more so for VCs than, say, angels. But you've got to put in the work. If you expect to be able to just spray your deck around like a million investors and get a hit, it's not going to happen, because quite frankly, like, if it were that easy, everyone would be doing it. And I think to begin the conversation goes exactly to what Carl was saying. You've got to engineer the FOMO and the and potentially the warm introduction, although today it's easier and easier to not need that warm introduction. I've approached investors on Twitter, on LinkedIn, by email, via their website, via introductions, via brokerage, if that's something that you want to do as well. Like, all of those are legitimate. You've got to find whatever the right in is for you. But I think certainly in the VC world, it's much more transparent than it used to be, and it's much easier to go direct. I think where it's harder is with high net worths and with family offices. Those are much harder to kind of crack into, and those are where you probably need a bit more of a warm introduction or some sort of understanding. If you can find one great investor for your business, you would be surprised at how many doors they will also open up for you. So that's the other thing. Like, if you can bring it, and I think, Chloe, you were talking about this in terms of the US investor base that you brought on. I think that's really valuable, right? Like, so my lead investor for my last round, he's been amazing. He's been absolutely awesome in terms of opening doors. He may not even invest in the current round. He probably will, but ultimately, he's opened doors for me that otherwise wouldn't have. And I'll give you a great example. Slightly to Carl and Rosie's point, I had some ins with Octopus and went through those sort of contacts that I had. He had a contact at partner level, and he just pinged the deck and said, look, would love if you could also give this a second look and just give an opinion. And in fairness, the guy came back and said, yep, no, we've had a look at it and completely buy into what the analysts had said at the time, or what the investors had said at the time, so we're going to pass. But that's really valuable to a founder. Like, if you're able to create those sort of those sort of second order sort of virality almost around the investor base. It's really, really, really important.
Absolutely. Chloe and Kyle, what about you? How did you do your research into figuring out what were the right investors to approach?
Yeah, so little less on the research in the early days. I was just like, just someone give me money. But so I think what you have to, in being in the impact space, so being within sustainability and within plant-based, there's a really nice community around that, which is great. And once you sort of crack in, so things like the Evolution platform, sort of like great for kind of like introducing you to sort of that kind of community, and then sort of growing out from there. So knowing your sphere, your area really well is a great place to start. So where do people really care about what you care about? So from an ideological alignment perspective, I actually was quite surprised that within kind of we're employee benefits, actually employee benefits isn't so huge. There are a few people that would invest within sort of HR tech kind of platforms. So we looked at kind of people within that space. A lot who have an employee benefit won't necessarily invest in you either, because actually there's conflict within the portfolio, which is quite interesting, because I thought, okay, well actually you're very aligned. Let's go after you. But I think in terms of ideology, that's been really important. As a female founder, finding investors who actively say that they want to support female and diverse. We're a very diverse team in terms of culture and ethnicity. So finding those investors who specifically want to look for female founders, again, you're more likely to get an introduction and to get past the gate if you're looking for those who want to invest in people like you. In terms of beginning the conversation, we've been much better at bullet pointing what we're good at. So, we have SEIS, we've got 100K, hopefully with a mini budget. We've got EIS, Advanced Assurance. We are female founded. We are diverse. We're tackling this and this issue. We are raising X. If you're interested, let me know. Just like really keep it short and snappy. But, LinkedIn's a great place to start.
Very helpful. Thank you.
I guess the only extra bit that I can find, which hasn't been covered exceptionally already, is around looking at other founders and speaking and doing your diligence on the funds that have invested in your friends as well, and doing that in reverse, because there's nothing quite like going down a funding process with a fund to speak to a founder that has been invested in, and then them turn around and say they're fucking awful, don't touch them with a barge pole.
Yeah.
Which is the fear angle, but actually more often than not, it's the opposite, right? Where you speak to, and you can do this organically with outreach on LinkedIn, to founders of companies that you aspire to that are similar business models in adjacent spaces, and say, hey, look, who are your investors? Are they good? Would you recommend them? What's good, bad, and ugly? And if you like it, could you give me an introduction? And I found that really, really beneficial for identifying those funds that aren't just lip service. Lots of funds say value add, and then when you get to the post investment, like Nirvana, are they actually doing what they say, or is there attention now on the next deal? And it's really useful to find those funds that practice what they preach around value add. And interestingly, Octopus is probably the top of that list. Octopus and True, whenever I speak to founders about value add, they're always the two that say, fuck me, they give me the time of day when I'm, looking at an opportunity, a threat, and things like that. So that's what you're looking for, to identify the best fund to help you, not just with the capital, but with everything else, and the journey afterwards as well.
Very helpful. Thank you. So we've got a little bit less than 10 minutes. I am going to move us ahead to the Q&A. Well, I guess we'll stay here. So if you have any questions, attendees, that you'd like to ask the panelists, please supply those in the chat or the Q&A function. We did actually get one question from a registrant that touches on something you've all mentioned a little bit in your answers, using LinkedIn to network. The question we received was, I'm finding I'm struggling with building new relationships when folks are still remote. What tools do you suggest for reaching out to people? So it sounds like we are all having some success with LinkedIn. Is that right? Or is there other tools you're using that have worked as well?
Can I very quickly, Kelly, add one more point to the last question? Just a couple of very practical things. As one, Techstars have an amazing public database of all VCs in Europe, which you can search by stage of investment, focus area, size of the tickets, which is a really useful starting point and kind of cheats the research point that Arish was talking about. And I'd also say Landscape VC is a new tool which has not been around for that long, but it's basically anonymous reviewing of VCs. And it's starting to get used a bit more. But if you go on there as a founder, you can actually look up the different funds that you might be talking to, and they have kind of reviews from people who've spoken to them and interacted with them before, and tell some of their experiences. So just two practical things that are worth bearing in mind as well when you're thinking about which investors to go for.
Those are great. Thank you so much for sharing.
Yeah, there's a few more as well, like Open VC, and I think Alex McDonald, who's a prolific angel investor, has done a newsletter, and he's got like 13 databases of investors. I would definitely recommend anyone who wants you to check him out, because there's a lot of valuable info in there. But I was just going to say on this, LinkedIn and Twitter are your friends. Like,
yep.
Don't be afraid of reaching out. Like Twitter, often people are really open to DMs. I've reached out to a number of investors via Twitter, but LinkedIn for sure. And I actually think remote has made that easier rather than harder.
Yeah.
Albeit that, you know, it seems like every week there is a new VC conference going on. I think Slush is coming up, or is going to be happening at the end of the month or whatever. Like, there are in-person events now happening, but there are also like remote ones, like the Seed Stage, which Hector Mason runs, and others sort of similar to that. But I definitely think at the outset, LinkedIn and Twitter, very, very, very useful and valuable tools.
Very helpful. Thank you.
I'd also just say, in terms of reaching VCs, every VC is different, but I find a lot of VCs can actually be much better if you can get them on email rather than LinkedIn. I think you can be drowned on LinkedIn with messages, and it can be quite hard. You can basically lose track of who's sending you what. Normally, VC emails are quite easy to get hold of online. So I'd say if you can, also try via email, and I'd imagine they're more likely to respond via email than LinkedIn.
Rosie, we did get one question I'd be curious your answer to. What's the most impressive detail you've seen in a pitch presentation?
That's a very good question. I don't know if it counts as detail because, I mean, as lots of people have said earlier, conciseness is really key in a deck. I think one thing that is quite rare, but that I find really helpful and interesting when people are putting together decks is sometimes, or a couple of times, I've seen people have a section on their own kind of investment risks, or what they would perceive as being the main risk areas for their own business, and then why they think they can basically counteract those. And I think if you can preempt the main questions that VCs will have as they're going through your deck, and you can probably get that from asking people for feedback, it can kind of answer the questions before they raise them. It might appease some concern, and it also shows a bit of kind of self-awareness and humility in that you're aware of all the pros of your business, but also you're aware of the risks and what might go wrong, and probably actively addressing those. So I'm not sure if it counts as detail. That might be a cheat answer, but I think that including a kind of what could go wrong and why we think it won't is quite an interesting thing that I've seen a couple of times.
Rosie, would you put that as a slide? Sorry, I'm asking a question now. Would you put that as a slide, or would you do that as a voiceover? So it feels like quite a commitment to put it like as an actual of one of your like 15 slides.
I think you could do either. I've seen it be done as a slide. I think if it's not a slide, 100% it's something that you should be prepared for when you're going to investment pitches, going through your own kind of thesis and deck critically, and thinking where are the main holes basically in my argument, preempting what those main questions are, and making sure that you've got the answers to those and good answers laid out. I think everyone should be doing anyway if you can. The only problem I think is if you put it in a deck, it can obviously, there are downsides to it too, but it means that maybe if those questions would have been a blocker, that would have stopped you actually having a first call with that person. But yeah, it can be done in lots of different ways, and there's definitely not a science to it.
Thank you for sharing. Well, we're right at the end of the event. I want to make sure, panelists, any last thoughts, tips, or words of wisdom for our attendees before we wrap up?
Just don't give up. Grit. you know, the last woman or last man standing in the current climate, right? And Chloe, I think all testament to you for saying it early on, because that's what gets you through. So yeah, good luck going into the cold winter.
Yeah, and I think I would just add to that. I mean, I haven't been there myself, but I think being a founder can be a hard and quite a lonely job, especially when you're going through a fundraising process and you're raising money and you're also doing your actual day job of running the company. So surrounding yourself with a network of people. So maybe that's like peers who are going through the same thing, other founders who are raising at the same time, that you can kind of lean on each other. Or finding a mentor who's maybe the founder of a company who's slightly later stage that can help you. I think basically building up that support network around you as well to make sure that it doesn't all get too much, I think is really important as well. And there are also some founder network communities and things like that that you can join. But yeah, again, I'd say good luck as well. And yeah, if there's anything we can do to help, then let me know.
With that in mind, given I'm at the stage that some potential listeners are also at the stage, if anybody wants to reach me on LinkedIn, Chloe Sweden, and reach out, and we can compare war wounds, and likewise, if I'm at a later stage than somebody else, I'm happy to mentor as well.
Yeah, I'd echo that. The other thing I'd also say is definitely resilience. 100%, Carl and Chloe, you're on it. And I think the other thing that I would really recommend to all founders, like if this is your first time in the journey, try and find a way of extricating your personal self from your business, right? You are not your business, and your business is not you. Any success or failure that happens in your business is not a reflection of you, right? Like you are already someone who has taken a massive risk in trying to launch something against a huge amount of odds. You should be massively proud of yourself for doing that. And I think too many founders, wrap themselves up in their businesses, and it really impacts them when things don't go the way that they would like them to. So, you got to have the resilience, but you also got to be able to step back and say, you know what, it's okay. I did everything I could.
Wonderful points. Thank you all very much for joining us. As a follow-up, we'll be sharing the recording out with folks who registered. And we also have some additional resources that we hope helps attendees' lives be a little bit easier, have them have a little bit more resilience in the tough journey ahead. But thank you very much for our panelists for joining us. The great conversation. It was wonderful. And we hope you all have a great rest of your day, and best of luck in your next milestone.
Thanks, everyone.
Thanks very much,
See you
everyone.
later.
Thanks, everyone.
Thank
Thanks,
you.
guys.